Your parents' financial advice might be seriously hurting your financial future. I know that sounds harsh, but hear me out. These 5 money rules that I'm going to be talking about today worked great in 1985, but using them today, following them today, it's like using a flip phone in 2025. Interest rates hit 15% in the 1980s. Inflation was predictable, and a simple savings account could actually make you wealthy. Remember back to the days of the passbook savings. You can actually make 5 or 10% interest, and you can actually see your money grow month by month. We just came out of 10 years of 0% interest rates where we all earned essentially zero. But finally, for the last couple of years, you can earn about 4%. It's still not what we saw back in the 80s. So earning money the old-fashioned way is much slower and doesn't work the same way. And those conditions disappeared decades ago. Following this investment advice today just isn't effective. It's actually destroying your financial future while inflation is eating away at your savings and steals perhaps 6 to 8% of your purchasing power if you look at what real inflation rates are today. The biggest financial crime isn't market crashes or bank failures, in my opinion. It's financial advisors still pushing 1985 strategies in the 2025 economy. Old school thinking isn't likely to work in modern America, not in my view. Hello, I'm Mike Preston with New Harbor Financial, and today we're going to be busting some myths, some old myths that you probably hear every single day. Strategy number 1, just buy and hold everything. Passive investing is the way to go. This is the first myth that really I want to dive into here. Look, I get it. The advice made perfect sense when your dad was starting his career, when your mom was starting her career. Over the last 40 years, all you had to do was blindly buy the market indexes and let compounding do its work. That's back when markets were more predictable. Markets were more free. And frankly, the information advantage was not there for individual investors. It favored big institutions. It favored just putting your money in the market and going along with it. And of course, the Federal Reserve and other central banks had your back. Here's what's changed. We're living through the most volatile market conditions in decades, the most volatile market conditions in our lives. Inflation is coming back with a vengeance. Interest rates are swinging to and fro like a pendulum. And geopolitical tensions are reshaping entire sectors overnight and adding more layers of risk to the market that haven't been there in the past. Passive investing assumes markets always go up over time. And while that's true over 100 years, that's not necessarily true over 5, 10, or even 20 years. What if time includes a 15-year period where your portfolio goes nowhere? And maybe it goes nowhere in a very volatile way. Perhaps it loses 50% and then claws back to even over the next 15 years. That absolutely can happen and might likely happen given where we are currently with valuations. What if you're 55 years old and can't afford to wait for the next bull market? What if you're 65 years old? What if you're 75 years old? Here's a chart of the Dow Jones from about 1915 to about 1975. So take a look at the Dow Jones topping in 1929, then lost 89% of its value. This is 1929 peak here. It then took until 1954 to get your money back. And I can tell you that the valuations of the market now are higher than they were in 1929. The only difference is we have a central banking system that thinks that they can prevent this from ever happening again. And maybe they can, and maybe they can't. I can tell you that valuations are higher now than they were then. Waiting 25 years to get your money back is just too long for most people. I can also show you a period of time here about 1966 or so to 1982. There's 15 or 16 years here that it took to get your money back, and you lost close to 50% along the way. Valuations today are higher than they were in 1966. And then, of course, in the early 80s, we were off to the modern bull market that we're living in now. And what we're living in now is the end of 4 decades of expansion and increasing monetary expansion and experimentation. And we think that that period is ending. And valuations are warning us to be very, very careful. It's no secret that we're big fans of John Hussman and his work. We think that he does some of the very best, honest, accurate work out there. It hasn't mattered. Nothing has mattered in the last 15 or 20 years because of quantitative easing and the fact that the Fed changed the rules. But take a look at this chart of valuations going back really over 100 years, about 100 years, about 1928. Take a look at the left side of this chart. It goes back to 1928. It shows you that the level of valuations back then is actually less than the valuations that we have now as of a few months ago based on this chart. It's actually even higher now. This is non-financial market capitalization divided by corporate gross value added. This is a variation of market cap divided by GDP the so-called Buffett indicator. This chart shows that we've never been more overvalued than we are today. Now, will it matter? Who knows? This next chart is a scatter plot of what happens when the market is this overvalued. What happens in the next 12 years? If you plot non-financial market cap divided by corporate gross value added and then divide that, plot that out versus 12-year actual returns, you can see that there is a correlation. And the correlation that shows where we are here presently as of a few months ago is about -6% annual returns, and the S&P 500 is expected over the next 12 years. Now, the only way that that can really happen is for the market to fall pretty hard at some point. It doesn't have to crash, but if it follows the model, you have to admit that you'd have less money 12 years from now than you have today if you invested passively in the market. So that's what you need to be thinking about, and that's why passive investing is unlikely to work. So what's the new reality? You need to be more tactical. You need to know when to take profits, when to cut losses, when to pivot strategies entirely. In other words, active management will likely vastly outperform passive investing in the years ahead. So the second strategy that's old school thinking is work hard, get a good job, save, retire, have a 401k. I attended a talk years ago given by Robert Kiyosaki, the author of Rich Dad, Poor Dad. So I'll give him credit here. Robert Kiyosaki was talking about how it makes sense to invest in real things, real estate. And frankly, when he sells real estate, and I know this from his talk over the last bunch of years, he puts his savings in real things like gold and silver. This is the old school thinking that kind of keeps people trapped into a job. Work hard, get a job, save, retire. It's the classic American dream playbook. And honestly, I just don't think it's the way that you should be thinking anymore. Here's the brutal truth. Savings accounts pay essentially nothing. We're talking, 4 to 5%. While real inflation, not the government numbers, but real inflation, the prices you actually pay at the store is 6 to 8% a year. That's eating away at the real purchasing power of your money. Saving money the traditional way is not the best way to grow wealth for the future. Your parents would put money in a CD and get 10 to 12% returns. Today, you're likely to beat inflation. If you can even stay up with inflation, you're winning. And there's no real guarantee that interest rates will stay up there. If we hit another financial crisis, the Fed is likely to drop rates right back to zero. And guess what? You lose out. That's just the way it is. It's been proven to us. Savers will lose out for the sake of the greater good. This is the way that the central bankers think. So working hard is still important. Don't get me wrong. But working hard without investment, without a good investment strategy, is just running on a treadmill where the cost of everything else sprints ahead of you. So you got to think differently. Here's some ideas to think differently. Think about investing in real things, real estate. I know real estate's in a bubble now, but I think that the bubble will come down. If the stock market drops in the next couple of years, like I think it will, the real estate market should come down and offer some good opportunities. There might even be some good opportunities out there now, particularly if you're willing to look at properties on the lower end of the rent spectrum. But just keep your eyes open and ready over the next couple of years for these types of opportunities. Gold and silver are still, in my opinion, good investments today, particularly silver. Trading at around $38 an ounce, I think it goes into the 40s by the end of the year. We'll see. And then start a business. The most wealthy people that I've met in my life are entrepreneurs. So that's why the go to college, get a job, save money, retire with a 401k does work. But the wealthiest people that I've met are entrepreneurs. So think about starting a business. What skill do you have that's unique? What skill do you have that's unique that you can charge a lot for? So just think outside the box. Don't think the old way, think the new way. Think about how to take charge yourself. The third myth I'd like to talk about here is retire at 65 and live off Social Security. If you're banking on Social Security to fund your retirement, we need to have a serious conversation. Social Security was designed when people lived to 68, not 85. The system is mathematically unsustainable, and even if it doesn't collapse entirely, benefits are almost certainly going to be reduced for younger generations. And we might see some kind of means testing that limits this benefit for wealthier Americans. Plus, retiring at 65 in an economy where healthcare costs are skyrocketing and inflation is destroying fixed incomes, you're not retiring You're just switching from earning money to watching your savings disappear. The new retirement reality means working longer, but working smarter. It means creating multiple income streams and having investments that can actually grow faster than inflation. Think back to when I talked about businesses. You might have a business that provides passive income, or if you can buy a portfolio of income producing real estate over your career, you can have passive income during your retirement. So think about multiple income streams, think about entrepreneurship, think outside the box. Now, I'd like to share a chart of the Social Security Trust Fund and take a look at just under a high cost, a low cost, and an intermediate scenario. And these are, basically cost is the efficiency of the economy. Under a median scenario with the market and the economy working okay, we're projecting that the fund is going to run out in the 2030s. I understand the government maybe wave their magic wand and change some rules, but I don't think that we should bank on a low-cost scenario. Low-cost scenario would essentially mean the GDP is expanding, the market's doing great, economy is doing great, unemployment's low. I think that we can expect the trust fund to run out sometime in the 2030s under one of these scenarios, under one of the other two scenarios, I should say. I do think that Social Security will be there one way or another, even if they're going to print the money to pay for it, but it is something to think about, whether you're means tested or whether the benefits are reduced or whether the retirement age is increased again. Maybe from 67 to 70 this time, who knows? The fourth myth I want to talk about here is skip the morning coffee and small expenses to get rich. This drives me absolutely crazy. We've all heard the math. If you skip the $5 latte every day and invest it, you'll have a bunch of money in 30 years. And I guess that's mathematically true. But here's what the advice misses. You're optimizing for pennies while ignoring dollars. Instead of obsessing over a $5 coffee, why aren't we talking about the $50,000 that you're leaving on the table by not negotiating your salary, or by not changing jobs, or the $200,000 that you're missing by not having a proper investment strategy? The coffee advice is financial busy work. It makes you feel like you're doing something without actually moving the needle. What we want to talk about here is doing the big things right. And I suppose also a corollary is by avoiding the big mistakes. Focus on the big wins, increase your income, optimize your taxes, make your money work harder, and then buy the coffee. Enjoy the coffee. You have to live too and enjoy. The fifth myth that I want to talk about busting is buy blue chip stocks, they're safe. General Electric was a blue chip stock, so was Enron, so was Lehman Brothers. Blue chip doesn't mean bulletproof. It just means big and established. And in today's economy, big and established can become big and obsolete pretty quickly. Look at what happened, traditional retail, media companies, and even some tech giants. The market moves faster now, disruption happens overnight. That doesn't mean avoid large companies completely. It does mean you can't just buy them and forget about them. You need to stay informed, stay flexible, and be ready to adapt. I'd also like to point out that just buying the market and holding on for income just doesn't work anymore. Over time, as the markets become more and more of a value, the dividend yield has gone lower and lower. It's a chart here that I'd like to share that shows the S&P dividend from 1917 through 2025. The dividend has gone from high single digits to just barely under 2%. The dividends will come back at some point. That point will likely be after the market falls a lot. The dividend yield will come back, but you're just going to have to be patient and think about other ways to get yield, and perhaps think about waiting for the valuations to drop before investing in these blue chip stocks again, or the market in general. And here's a hot take. It's just a quick note that might surprise you. Your home is probably not your best investment. I know everybody says real estate always goes up over time. Your parents probably made a fortune on their house. But think about it. Your house doesn't pay dividends. It costs you property taxes, maintenance, insurance, and an opportunity cost on that down payment. And unless you're planning on downsizing or moving somewhere cheaper, you can't really access that equity without taking on debt. Meanwhile, the same money in a well-managed investment portfolio could be generating actual income and growing faster than real estate appreciation. Your home is shelter first, investments second. Don't let the tail wag the dog. I'm not saying your parents are wrong. The advice worked perfectly over the last couple decades for their era, but the rules have changed. If you want to grow wealth in 2025 and beyond, we need to talk about changing some things. The house, maybe wait for it. Home prices have gone up so much faster than incomes. Perhaps it makes sense to rent. I do believe there's going to be better opportunities for homes in the years ahead. It isn't an easy time for young people. I have a lot of empathy for young people that have to live during this bubble time, during a time that prices always had to go higher just to keep the system intact. In other words, if the stock market falls, we have a lot of other problems. Unemployment goes up. profits go down. If home prices go down, towns and cities can't afford their bills anymore because they have all had a huge increase in their tax rolls because of what's going on. So it's not an easy solution. We're living in the everything bubble, and the everything bubble is really hard on young people. And it's really great for old people. But those times are likely going to change. If anything that we talked about here resonates with you and you want to build a financial strategy that actually works today and in the future, check out the link below in the description. Reach out to us. We're here to help you navigate this new financial paradigm. What strategy surprised you the most? What strategy do you think, or what strategy or traditional myth that you have previously thought works, are you now questioning would work in the future? Leave some of your comments down below. We read every one of them. Don't forget to subscribe to our channel. We really appreciate it. Like our video. Click on the bell icon to get updates. And we really appreciate you watching. Please reach out to us. We're happy to have a chat with any one of you that wants to chat. It's a free conversation. I am Mike Preston at New Harbor Financial, and I'm so happy that you tuned in today. Thanks for watching.